right, we got 7 people. Awesome. 8
All right, I want to
people.
welcome everybody. There's still some people signing in, but I want to welcome everyone to today's webinar. I'm Ryan Fisher with Camaplan. I'll give you my contact information in here in just a moment. But we have Kaylee, the apartment queen, here today to give us her knowledge and expertise on what she's been doing. So let's just hop right into this. First of all, quick disclosure, Camaplan does not endorse or give any investment, tax, or legal advice. Do all your own due diligence before making investments. Consult with your accountants, CPAs, realtors, or other professionals before making any investment. Real quick though, what is a self-directed IRA, right? Basically, a self-directed IRA lets you invest in anything that you want. There's a few things that you can invest in, and I'll show you that in just a moment. But collectibles and life insurance is what the IRS says you can't invest in. This is what we see the majority of our clients investing in: real estate, and Kaylee's going to talk about that today. Precious metals, that's physical bullion stored in a depository. Notes, mortgages, it's another big field. And then private placements, which Kaylee's going to talk about as well. That's private funds, and that can be in real estate, notes, private companies, etc. You can use all these types of accounts. You have the tax deferred accounts like your traditional IRA. Then you have the tax-free accounts such as your Roth IRA or health savings account. You can even partner these accounts together or with other people. This is my contact information. You can reach me at rfisher@camaplan.com. That's RFISCHER@CAMAPLAN.com, or our toll-free number 866-559-4430. I'm going to turn this over to Kaylee, but why don't you tell us a little bit about yourself, Kaylee?
I just thought this would be a funny plug. Most investors would totally laugh if we told them they could own a part of a $17 million building by only investing 50 to 100K, but you can. And as owner of that property as well, we cover in this presentation tax advantages, K1 income, what that means for you, how to avoid excess taxes, so UBIT and UDFI tax, and how you can have zero liability as a limited partner or limited liability as a limited partner. And you can, again, invest via your IRA or retirement accounts tax-free, which is freaking awesome. What you're looking to do is to either transition out of your W-2 job eventually or retire. I'm sure everyone will be at that point at some place, or be at that place at some point in their life. So this is a great presentation just to get your mind ready to do that, or to get going today, how to start transitioning to have some more free time, and we can help with that. So basically right here just explains that my main goal, which if you know this name, Apartment Queen Investments, we want to create financial independence and space for women, especially experiencing toxic codependency in relationships, which hamper their ability to manifest their amazing reality, like what it could be. My company models changing the face of multifamily, because all of our leads on our teams are females. Most of our limited partners are females or men that support the economic empowerment of women, aka financial freedom of women, so that we're able to give back to our communities. 80% of us do, and we're able to make our own decisions to do the best thing for our life and for our children, especially in single parent households. So our vision is to create 1 billion Shevesters by 2030, and we can't do that without your help. This is a little bit about me and what we're going to cover.
All right. Thanks, Kaylee. I'm going to stop my share and you can start yours.
Oh, you betcha. And we'll do this one. Share. I'm trying to get better at the actual, just the screen sharing instead of everything. Showing y'all everything, you know, which I just did anyway.
No problem.
Okay, so what we're going to bring today, if this will play the right slide.
All right.
Yeah. Apartment Queen Investments today is about passive investing in apartments and what it can do for you. Strong returns and getting your life back is really what we're going to be covering. So everybody knows you can't do it all. Finding and analyzing good apartment deals is a full-time job, and you must be trained to be able to spot the right deals so you can do them quickly and execute your business plan and find these apartments. Also negotiating, inspecting, raising money, post-closing, managing the property without experience is just a disaster. And risking your capital to secure deals is also part of that full-time job and is also a big risk that you could carry trying to do it all. You'll need to execute your business plan, rain or shine. You got to show up every week, all the time. There's no excuses. Things don't happen. You still have to do it for a minimum of about 5 years on these deals these days. And you're running a large company. It's not a hobby anymore. So that's something to keep in mind when getting into these deals. The problem being that, you can't do it all. And so, here we're going to talk about how you can still participate. So for example, here's the other problem is you will start to you will not pursue your purpose. Basically, that was misspelled. So here's a couple of things. So this is all the stuff you got to do whenever you're starting brand new and trying to get into multifamily or even commercial real estate. You got to learn operations. You got to be able to operationally operate. So meaning like, marketing, advertising, construction, systems, people, all the different departments that you have in a company. You got to learn how to make all those work and time them right and manage people. You also have to learn financial modeling. That's probably the first step in this process, but that does take a lot of experience and a lot of studying capital markets consistently. So it's great to have somebody on your team that is going to do that as a full-time job anyway. You're also going to have to learn construction in commercial real estate. And so you're going to have to direct people. And there's a lot of things that happen all the time. And so, if disasters are not your thing, you're not going to enjoy managing construction crews in commercial real estate. You also have to learn property management software, just enough to be dangerous because you need to know what's going on and kind of have your eye on the ball at all times, kind of see the moving parts. And so if you don't have a clue about Resman, Yardi, there's so many different ones out there. Exactly when you look in there and there's certain numbers missing or there's reports that don't make sense or certain things. I've just dealt with so many experiences where people that have been doing this a long time know how to skirt around and even lock reports so that you can't get certain information that you need, all of your balance sheets, all of your, everything basically. So you need to know your management software. So you have to learn a lot. That took me a while. And you also have to spend your time managing the project. So again, like I mentioned, you got to show up all the time. And it's not that you can just stop showing up. You have to continue, but your time will be spent actively managing these projects. Also staying available because sometimes emergencies happen. I'm not saying that, you're going to have to be the direct person that gets the call whenever there's a fire to actually go activate all the systems and to deal with it. We have property managers and things like that in place for emergencies, but you still have to guide the whole process. For example, insurance claims, anything that has to do with the title, anything that has to do with funds on the property, you're ultimately responsible for everything. You got to be available. So because you have to be available, there's less time for hobbies that you may want to pursue in your life. Also, you have to spend a lot of time driving, I'll be honest with you. So when you're looking for properties, when you're visiting properties to do like a quick little look when people don't expect you to come asset manage, etc., you're going to be spending a lot of time in the car. And there's a lot of time that you can't coordinate with your family just to be able to leave whatever they're doing and geographically be wherever you are. Sometimes, sure, but you're just going to be spending a lot of time without your family. So it just depends on what your priorities are. And that's what it would look like if you're going, do I my passive, am I active? What's great about being passive? You don't have to deal with any of that stuff when you're passive. Also, again, when things start to break down after all those problems are had, again, time is limited. You spend more time searching than making money in the beginning. Also lacking time, again, like I mentioned, to pursue your passions. And here's the cold reality sometimes is that you don't truly have financial freedom if you're actively managing properties. So let somebody who has chosen that path for their life to do that for you. So you can, like I said, avoid all those problems by going ahead and moving into passive investments. So what would be the solution? Passive income from experienced sponsors so you can focus on your mission and your why. So what do we do? What do sponsors do when it comes to giving you passive income? I just want to make sure we cover the gamut so you guys know how much we do. We find deals, we negotiate those deals, we secure and raise the funding. We also secure, like I mentioned, loans. And so these are multi-million-dollar loans that we have to have a certain liquidity and net worth and level of experience to be able to even get qualified for these loans. So a lot of individuals that want to do this stuff, that would stop them dead in their tracks right there. So it's part of our team and we use our experience to be able to get the deals going. Basically, that's the first step. Then we use our knowledge base to be able to operate the properties. We worry, we worry about tenant turnover, upkeep properties, and even capital improvement by our business plan and consistent execution. That's what we do, or what a sponsor does. A sponsor also is dealing with tasks and projects consistently every week, all the time, executing. So they're inspecting, improving, asset managing, refinancing. We triage disasters, like I mentioned earlier. We have accurate accounting. We always have to make sure of that. Consistent reporting, distributions, tax forms. We position the property for sale, and so much more. It's a constant job. And so I just wanted to show you guys that sometimes when you look at it as a passive investor, oh, it's, that our job is easy or something like that. It's really not. So these are all the things that as a passive investor, you can just count on us your sponsor, to take care of that. And why does experience matter with the team that you're picking? That's one of the biggest things as a real estate professional, and also picking a team that's full of professionals. As a company grows over time, communication and cross-functional collaboration become more complex and more important. So experience will help us to know what the next steps are to take, no matter what happens with the market. Experience we can pull from things that have happened in the past, and again, being able to pivot based on experience in this specific market. And then we also have people that are involved with us that give us advice in just general in business. What's the best policy, what's the way to handle things. So anyway, experience really matters when you're looking at your team. And I want to let you guys know there's a couple of benefits that you might not think about when you're looking at investing passively. So here's a few things I want you guys to know about. So for example, with commercial real estate, such as apartments or office spaces, there's a potential for a higher return on an investor's dollar due to multiplying the units, aka the income. You're also building your portfolio, so you have an operational team that's going after multiple deals. So being able to participate in multiple deals builds that portfolio of yours, and you didn't have to go do it. We're the ones bringing deals to you, and also it cuts down on the networking you have to do, especially if you pick one operator that you like over time. You get to take advantage of downturns because we have more units and properties spread across the investment. To spread your investment across, So basically, for example, if you are investing into a very small, like 4-family, 5-unit property, you really have more risk than if you were invested partially in a 262-unit deal, for example, or even a 100-unit deal. You take advantage of the downturns because even when we lose people, even when we have bad debt, it really is less of a risk because of so many units. And then again, it's not 100% vacancy like if people leave like a 3-unit or 4-unit or so, or 75% vacancy really quick. So, and then also with the downturns, people tend to go from houses to apartments depending on, the right market. And that's another pro that we can take advantage of downturns. People go, like I said, to the renter situation usually. Also, here's another advantage you probably already think about, but just want to reinforce that the investor would just collect checks and watch their money grow. So that's something that is obviously a benefit. Also, here's another benefit. You would be building a stream of reliable passive income without taking too much risk. So, like I mentioned, you're putting in that 50, 100K and the whole deal, for example, is 5.7 million or 10 million or 50 million, whatever the deal is. Your risk is relatively very small compared to what we had to put up front, what we have to put up front for risk capital, and the fact that if anything goes wrong, the general partnership team is the one that basically holds the bag, if you will. So we take on all the liability. So you can get that reliable stream of passive income without taking on the amount of risk that we do. You also get to save money on taxes by ensuring that you don't make passive income in a higher tax bracket. So passive income is taxed at a lower amount. And then also, depending on your career, you can also offset your active income taxes being a real estate professional. And again, I'm not a CPA, but there's possibilities there to be able to be a real estate professional and be able to really utilize the decrease in the amount of taxes that you have to pay. Also passive income that you get, like I mentioned, without risking too much of your own capital. We put up front 10 to 16% of the entire raise. So for example, if we're going after a $50 million deal, that's a lot of money, right? And we're also putting our money down in the beginning to secure the property. So the earnest money, all of the retainers for the legal fees, all of the inspections, all that stuff, we put that up front. So and that's risk, because as we go through to figure out, does this property fit everything that we need as we go under the hood, we could lose all that capital. So you're not in that position. Passive investors look at our deals and our funds once the property and the plan has been vetted. And then also investing through a sponsor can provide desired level of passive income and less risk than a stock, or as y'all have probably market can do. For the most part, with this situation where we're talking about real estate, especially commercial real estate, It's long. Typically, it doesn't go to very, very lows or very, very highs. It's kind of in the middle. So depending on the type of asset class you invest in, your investment can be very risky or really low risk. And with the higher the risk, the higher the return. So we like to stick with the middle. So it depends on what your sponsor is investing into as to what kind of risk you're looking at. And like I said, did we mention that you can invest with your retirement account tax-free? So that's something really cool. I kind of want to ask Ryan a couple of questions while I cover this slide so you can explore this with us a little bit more in depth. But for example, like I mentioned that we can invest tax-free with your retirement account. What does that look like? And we already mentioned what retirement accounts that exist. How would that look? And then what do we do about UBIT and UDFI tax?
Yeah, great question there, Kaylee. The process is basically pretty simple. They'll open an account with us and move the funds from, their IRA or 401k or 403b, whatever, retirement account that they have. That's very simple. It's just easy. What's that?
I said TSP, traditional. I mean,
yeah.
There's so many.
Yeah, as long as it's qualified funds, they're able to move it over to a self-directed account with us. The UBIT and the UDFI, UBIT stands for unrelated business income tax, and the UDFI is unrelated debt financing income. So that's going to depend on the structure of, the private placement or the deal, however they've done it. There's ways to avoid it. And, I'll leave that to the accountants and attorneys. But for example, if you were flipping properties out of your self-directed IRA, the IRS considers that a business because you have inventory in and you have inventory out. So they say, well, you're gonna pay some taxes on it. And we won't get all into this today, and that's for another time. And we have some recorded webinars that go into more details on this. But the UDFI, so if, for example, you invested in a fund and they had debt, then that may apply depending on how it was structured. If it does have debt, then you're, IRA. And it's not like you'd see articles out there that are on both sides. Some are like, well, why would you use your retirement account if you're going to pay some taxes? That just seems stupid. And other, it's like, why wouldn't you do it? I mean, I had a guy that said, well, I'll do it with both, but I have the money in my retirement account and I don't have a bunch of money sitting over here in my discretionary funds. But if I did, I'd be doing it there and I'd be paying some taxes anyway. So it's still a good deal and I'm going to make money. So in my opinion, I don't think that it's bad. It's just something to be aware of. And, as long as you're still making money, I mean, the good thing, I kind of joke around with people. I mean, we all hate writing that check, but the good thing about paying taxes is it means you made some money. So I don't look at it as a negative.
Yeah, one thing that I've been learning about is how to avoid the UBIT UDFI tax. A couple of things, depending on how many people you have in your company. A solo 401k can do it. A qualified retirement plan, QRP can do it. And then what I also have learned recently is that, for example, our deals, they are debt leveraged. We do definitely go get debt on the building. And I would say most of the types of investments you'll get into are like that. So one way that I've learned is that there's like a capital stack. So for example, we have like the loan, we have our equity holders, so usually our limited partners, and sometimes our investors that are, this is just a fit from my experience. It could be all kinds of people, but that are like hard money lenders, and they're used to using their capital to lend. They can actually lend as a second lien position, but it's a preferred, so they're basically debt. So they are not part of the LPs. They're a preferred partner. So anyway, point is that it's structured a little bit differently, and you can avoid UBIT UDFI tax by being in a different position in the mezzanine or like in the capital stack. So sometimes we can do that for like a higher or different preferred return for that investor. They don't get to take part in the capital events that we have. So every investor normally is part of like a cash out refi, distributions of the income or our rents, cash flow, if you will, and then also sale proceeds. The lender basically, or this preferred lender would come in and basically put a soft lien or no lien. They would put debt up basically, so you can avoid that. So I learned about that recently, that there's ways. We've been flexible to do that with some people, and there's probably some other ways that I don't even know about yet, but I'm learning. One thing on this slide I wanted to cover. So for example, I talked about K1 income, and this is not a tax webinar. I'm actually putting together a tax webinar with CPA Vince Porter, so we can actually have him talk about all this stuff, because I can't in detail. Like I said, I'm not an attorney, I'm not a CPA, but K1 income is awesome. It really is. So sorry about my shoulder floating left or whatever. But basically K1 income, like I mentioned, means that it's taxed at a lower percentage than income. And so my goal personally is to get all of my income over to passive or K1 income. And then also, like I mentioned, if you're a real estate professional, there are ways that you can basically take losses against your income from your K1s and be able to offset your active income taxes. But there's certain designations you have to meet, and it depends on your investment and other sources of K1 income that you have. So again, that's a CPA question to figure out, where it is that you lie. But for me, if you make $500,000 a year and you're paying half of it in taxes, like you're basically making $250, and you're probably working like 4 months or 3 months or whatever of the year to make the remaining amount, you might as well work less and make that less. So it's about how much you keep, not how much you make, if you ask me. So this type of investment can help you to use your retirement funds you already have tax-free, and then also to get into passive investments where you can help to reduce your expenses. So it's kind of, in my head, the same thing as increasing income. You see what I'm saying? So that's one thing that we can do to help people to be able to, make more money, or basically not pay out so much, which for me is a great thing that I've been able to experience. And then, like I already mentioned, you don't have liability as a limited partner. So for example, the investment amount that you invest into the deal in a commercial syndication is kind of what I'm referencing. You're limited to that amount, losing that amount, and really in the industry, I've only met one operator over the lifespan of being in this industry that like they just completely lost everyone's investment. And at that point, it's a securitized offering. So then we have the SEC that gets involved basically to try to recover those funds. But not if the whole project fails because the operator, I don't know, because honestly, if it comes to flood, insurance, death, all kinds of things, we have insurance to cover all that stuff, and usually that ends up being a good situation if no one gets hurt. But anyway, point is if something just goes terribly wrong, and the LPs are limited, if there's something that happens, the general partners, we, like I said, kind of hold the bag. So in Texas, it's a homestead state. They don't go after our homes, but they can go after our other assets, our businesses, our cash flow, any kind of settlements we have. I mean, it can go on for days, but limited partners don't carry that burden. So, like I said, limited partners have it right. And did we mention there's less work involved with passive investing in apartments? The capital that you invest can therefore go further, meaning that passive investors get a better return on their investment than those who don't use passive investments. I mean, that's kind of like duh, but some people compare active and passive all the time. And if you're able to invest in multiple different passive deals that might get different levels of return versus doing one project by yourself as an active investor, and you're getting all these returns from different places with the same dollars, that basically means that you're making better returns than those that don't do it passively. So you're only limited so much time that you can do things with.
Kaylee, I am going to jump in real quick there. And I do want to encourage other people, if you have any questions, you can put them in the Q&A or the chat box. But there is a question here that says, from your experience, how has COVID and the inability to evict non-paying tenants affect returns on, passive incomes or passive investments, it says?
Yeah, so I've seen kind of like the whole gamut, if you will, because I've got investments. What I have done is I have followed other investors that have been able to go into markets that seem very risky. So outside of Dallas, Fort Worth, so secondary markets, tertiary markets. And because they already have the team established there, and because I can watch them basically already execute a business plan, which is always similar to mine, which is, some sort of value add, I've been willing to take risks with investors' money and go follow that market and utilize all those people. So the point is, it's been proven that even though on paper it doesn't look like it can turn out great returns, it can. So what's interesting about being in those markets is it's not a primary market. So I've been able to, or have had to, get bank debt on properties. So during the eviction moratoriums, I had a handful of properties in like West Texas and outside of Dallas, South Dallas, and some other places that did not have agency. When you had agency, so Fannie, Freddie, multifamily loans, we were restricted on who we could evict if we wanted to take a deferral during that time period. And so with the loans that we had, for the most part, we either didn't take a deferral that were Fannie or Freddie, or in those bank debt situations, we basically were able to evict, continue to evict. It didn't make a difference. And honestly, what I found in those secondary markets was that people in Texas seem to be very proud and they want to work. And a lot of people weren't coming up with reasons why they wouldn't pay their rent. We would be creative with them as far as saying, okay, well, you don't have to pay everything on the first. How about we use a credit card instead of a payment plan? You can pay on the first, the 5th, the 15th, whatever it takes to work with you guys to make sure that you can pay your rent. So we were able to collect the rent that we needed throughout the major part of 2020. And then also with the eviction moratoriums, because they were paying, we didn't have to get rid of them or even have that conversation. And again, we did have like 1 or 2 people that were just really, they were already giving us problems before COVID ever hit. And so actually, because those small towns, like the local judge, we knew him. And so we're able to kind of like work it in, like we're on the top of the pile as soon as we were able to handle that. Now in Dallas, Fort Worth, we had a couple of deals that were the opposite, that we really had restrictions on evicting people. And so again, we just went back to them and tried to make it very flexible with how they were paying. If that still wasn't enough or they lost their job, then we were actually helping them in the offices to apply to different programs, whether it was state or national. And so basically one property, for example, if I look at like, it's like 200, it's like, I think we're getting like $100,000 a month or so in rental income just from those programs until these people get back into a job. And so now the next step for us is being able to give them access to like whether we're trying to give them information about job fairs or whether we have some people that can come in and like on the weekends, basically give them jobs because people are hiring again. As of now, it's kind of wonky with like, we've still had troubles with having to overpay people because so many people won't work. But as of, July, the end of it, we just did have those checks stop happening. So the stimulus checks or whatever. So not whatever, sorry, it's unprofessional. The stimulus check stopped last month. And so now we're seeing people wanting to work, applying for jobs. And so we're willing to help our residents. So really it's just part of you got to pitch in, you got to be creative, you got to put in some effort. And so this last year has been an incredible amount of work. Incredible, more than normal. Like normally these deals are already a lot of work. And then we have had 2 fires and we have like, a certain tenant base, a resident base that is challenging sometimes. And so that was just basically, so if you had operators during this time that were able to continue to either distribute, and what we probably did, or what we did do on the properties where we did have some trouble for a while, is we ended up, because we have to give investors money, so we just basically reduced the amount of cash on cash return that we are going to be distributing. And we said, what we're going to do is use our catch-up provision. So now that we're sure that we have reserves to be able to cover any more vacancies, like mass vacancies, any more, COVID restrictions where we couldn't kick people out. We made sure that we had the money aside so that we never had to stop paying our bills or have any kind of foreclosure challenges or any loan challenges, to make sure to be able to get the investors their money. So we just, like I said, had to be creative and then make sure that we had the reserves aside to be able to cover oopsie and yikes and all kinds of things coming that we can't predict. And then when we had more cash flow over that amount, then we started distributing. So for example, on one property, we distributed 6% versus 9% on one property. So basically we just had to adjust depending on what was going on. And like I said, first stop was work with the residents to be able to work with what they could do. Sorry, it was a long answer. Long. Super long. Are there any other questions, Ryan, there?
Yes. What are the target markets you are investing in?
Yes, so the target markets that we're investing in are not really anymore, but kind of Phoenix. So mainly in Texas. So I've got an associate in LA, so she's focused on Phoenix. But I focus primarily, in the boots on the ground here focuses on Dallas, Fort Worth, mostly Fort Worth, to tell you the truth. Northwest Houston, we really like that area. We are not confident in San Antonio yet, unless like an awesome deal popped up. I still get them, but I just haven't been able to figure out that city because the crime is so crazy and it varies. So basically major MSAs in Texas. And then like I mentioned, we're going after secondary markets now. So like Corpus Christi, Amarillo, we've got 2 deals in each of those markets right now. And also some other secondary markets that are over 100,000 people in population, like Abilene, we would do that. Lubbock, I would do it. It just has to be the right deal, because what I'm finding is that there are some mom and poppy stuff still existing out there where over COVID, they let people move in. They didn't know how to market online correctly. There's some kind of like glitch in the business plan or like lack of planning. I'm not seeing a lot of over leverage. I'm seeing more of that like in Dallas, which will come out on the tail end, I believe, in 2023. So we'll be going after, I think, coming back here in like a year or so, because I'm seeing some stuff. But anyway, so secondary markets are something that I focused on right now, just because there's opportunities where they could use a professional touch to managing the properties.
That's it for the moment. So go ahead.
Okay. Yeah, let me know. Okay, so what methods can I use to invest? So as we already mentioned, there's retirement accounts. You can invest tax-free. You can use your cash, and there's opportunity cost. Sometimes it's lost there. That's why people like using their retirement account so much, because maybe you need that cash for living expenses. Maybe you need that cash for something that happens in your life. And retirement accounts are set up to where you're not supposed to spend it to benefit yourself. And so when you're investing in deals that an operator has put together, you're not benefiting yourself or your own company to incur extra tax. Or Ryan could probably explain that a little bit better. Ryan, would you put that into better words? Like you're supposed to not pick your descendants and ascendants that benefit you.
Yeah, I mean, disqualified people is linear ascent and descent. So stemming from you, your spouse, parents, grandparents, kids, grandkids, or any business or entity you own 50% or more of or have control of is a prohibited person or entity. So for example, you couldn't buy a house and say your dad's an electrician. Well, you can't hire your dad to do the electric work because he's a prohibited person. You'll have to get someone else. You couldn't buy a house and, rent it to your son or daughter. But you can brothers, sisters, aunts, uncles, cousins, your best friend. They're all people that you can use. But yeah, the retirement accounts are, it's pretty clear and it's easy to kind of follow those rules. Does that answer where you were going?
Yep. Absolutely. I put it in better terms than I could, for sure. So obviously y'all know how cash works. And then some portfolio or some crowdfunding platforms that are out there, and there could be other ones too. There's some actually custodians that can let you invest in cryptocurrency, but that's not what I'm talking about. I'm talking about paying for your investment. So there are some crowdfunding platforms out there that allow you to use like Bitcoin and other cryptocurrencies to be able to invest in solid assets, which I think is pretty cool. They usually have some kind of an escrow company or a bank that's hooked up with them that will do the conversion. And so I think there's fees involved. But point is there's some people that have really made it with crypto. So, why not use it to fund something that actually benefits? So like real estate actually benefits from inflation. So there's a lot of other currencies and things that don't. However, real estate does. So I think that's pretty cool. So you're seeing a lot of changes out there. And then I just want to walk you through how our process works. So each different operator has their own process, but it's pretty similar. So hopefully you can see this. Number one, I would say to get educated. That's the thing that any investor needs to do. It's the easiest type of investor for us to deal with because they would ask questions and already know enough to be dangerous, if you will, or just highly experienced. That would be great. So that way they know what they're getting into. They know what questions to ask. And if you're not experienced, again, go get educated. That's how you start getting experience. So we do these webinars on purpose so that we can get you educated. Then you want to get qualified with us. That's what we do next is we want to figure out, are you a sophisticated investor, accredited investor? And you can learn what that means. But basically on our website, for example, we have a quiz that you can take and it will tell you which one you are. And then basically once you figure out what you're qualified for, then you can get into our different portals and go look at what you qualify for. So for example, if you're accredited, We have one portal. If you're not, we have another portal. You'd go in there to review your documents. So each different investing firm is going to have maybe even a Google sheet. I don't know if they're newer. And then usually people like myself or even bigger REITs, they have some kind of platform or some kind of software that you can log into to see all the information you'll need. You'll need to review likely a webinar that we have that's either live, or if you can't make it, then there's usually a recording that's in the portal. And usually typically every different sponsor will do a webinar, because basically what we're doing is we're simplifying 78 to 110 pages of documents, which are called your private placement memorandum, your company agreement, or operating agreement. And so those are the things that you will need to review, of course, but that webinar will usually cover the business plan, which is always sandwiched into the PPM, risks of the market, pros of the market, the sponsorship team, our experience. I mean, all the things are going to be in that PPM mostly. But I also would say to review the operating agreement, because you want to know that, for example, things aren't going right. Like, how is it clearly delineated, I think I said that right, like a buy sell clause? Or for example, like, does your investment allow us to get out early and basically be recapped early? Can we sell our shares? Like, how does that process work? All that would be in there. So that's that part of the process. And basically, once you decide that this is an investment that meets your criteria, meets your meets all of your criteria for this type of investment, then you would sign subscription documents and an investor questionnaire. Sometimes you don't need the investor questionnaire. Like I mentioned, our crowdfunding platform, that's not necessary, but you'd be filling out your documents. Then basically it will tell you in your documents how quickly each different sponsor would expect you to be able to fill out the docs and wire. And then basically we would let you know once the property has closed via email. And then what we do, and every sponsor is different again, is after that, we would give you about 2 months to wait before we start regular reporting. In our reporting, because we need like a month of data from the property to make sure that after we close, cockroaches kind of scatter, if you will. We want to make sure we know everything. But then you'll start getting monthly or quarterly reports depending on what your sponsor says in the PPM, and then you get mailbox money. So that's how that works. Did another question pop up, Ryan?
Yes. What type of returns can I expect if I invest 150,000 in this type of passive investment? You said that you had reduced investor payout from 9 to 6. Is that normal return on investment?
So I don't know if you heard the whole long spiel that I gave. Unfortunately, it should have been a lot shorter, but basically I was through what happened during COVID. So things like a market crash or COVID can happen. And so in that situation, yeah, the returns are going to be reduced. But like I already mentioned in that long spiel, that most of and again, you got to read the operating agreement and mainly the PPM, is there a catch-up provision for returns? So the projected returns that you look to get on the back end or in total, so annualized in total returns, is there a catch-up provision? So on those different deals, we had a catch-up provision. So when it made sense to not drain the property, because we don't want to ever put ourselves in a red zone where the property has to, like I said, we're in a panic to sell at a lower price, so you will not get your return as expected. And then also we don't want to get ourselves into a position where we have too low of dollars in our accounts and we can't keep the lights on and pay the mortgage and make sure to keep our lender happy. We do not want a foreclosure ever on these properties. So it's our responsibility to make sure that it gets paid. So that's first priority. Like the first lien holder, that lender, that's the first priority. Then our bills, and of course, then the investors, and then the sponsors. That's typically how we do our deals. So if need be, we can adjust. Again, there's catch-up provisions. So each different sponsor has a different range of returns. Usually what they'll talk about is your cash on cash return, which is your annualized return on your cash. So for example, after net, all of your expenses, all the expenses, taxes, everything, after, and this applies to any investment, basically what you're doing is you're figuring out what would be the return that I'm getting after net expenses compared to the initial investment that I gave to the operators or put in that deal. And so basically, and then that's annualized. So then that would tell you that, so for example, we do 9 to 13% cash on cash for our fund. There are different operators out there that do from, I've heard 6% to, I think 15 is probably the highest that I've ever heard right now. So it just depends on the operator and what they have produced in the past. And then therefore that would show you how realistic those returns are. Then they'll also talk about internal rate of return, or IRR. And IRR, I don't want to get into the whole thing, but that would be a more meaningful metric to someone that came from maybe the stock market, because you want to know internal rate of return. And so for us, our minimum IRR is 15. I've got a deal right now that's 16, a deal that's 18. So it just depends on, and I've seen ranges probably up to like 26, I think is the highest IRR that I've really seen, maybe 28, could be wrong, on some other operators' deals. And then you'll want to know your equity multiple. To me, that's the most meaningful. So for example, if we say, hey, we have a 1.75 equity multiple, you put 100K in, that means you're going to be getting back 175K on exit or before minimum. So that doesn't include a bunch of the other metrics like your annualized, or sorry, not annualized, any kind of cash out refi or any other kind of capital events like I mentioned. Not, again, we can't count on this, but sometimes we have events that happen, like we had several fires, and then from the fires, if it's managed correctly, then we can actually negotiate with the public adjuster to get more money what we actually need to do the repairs, and then we already have our capex or capital expenditure budget already, so we can kind of sometimes use that to do what we need to make the property nice, and especially do income producing improvements, and then distribute the remaining to the investors. So that would have never been an expected part of the return. But anyway, so the point is yeah.
So let me ask you a quick question there on there, just to make it a little bit more clear or summarize what you were saying there. So even when you bumped their interest down, let's just say you were paying monthly interest at 9% and you bumped it down to 6%, that was to keep everything par for the moment. But you said there's a catch-up clause, so while you paid them 6%, you can still catch up so that they get the return that they had at some point once it goes back to, you know, the operating level that you need it at.
That's right.
Is that correct?
The projected returns. That's exactly right.
Okay. Righty, go ahead, Kaylee.
Thank you for doing that for me. Like, so hopefully that was an answer to your question. Nice job with the summary. So just a little bit about us, and I can share this presentation with you if you'd like. There's links attached to it. So we started in 2018. So far, we've got 400 plus investors in all of our deals. We've got 20 million raised as a team. I've got 750 doors, but we have 111, another 111 under contract now. So soon we'll be close to 1,000 doors, but that was in 2020. So it's pretty impressive. And then now we have our first crowdfunding option for non-accredited investors. So that also helps individuals that normally they go, oh, well, my account only has 20,000 in it, you know, for a IRA, I cannot invest into any syndications because the industry average is typically 50. We've given the ability, and some other crowdfunding offerings offer this as well, where you can get in for much less. Some actually are higher, like CrowdStreet, I think, for example. But anyway, so the opportunity to lower the barrier to entry so that you can get started now versus waiting, because when your money is sitting there in mutual funds and certain accounts, I mean, it's making like 4, 5, 6%, I don't know. And imagine if you could double your investment in a few years. You know what that would do for your retirement account, increase the velocity of money, get compound interest curve, of course. So that's just a little summary about us. And then this is a little bit about us as well. I'll put this in the chat, just our website. So this link on the slide deck, if you wanted it, you can have it. But basically what it does is it redirects to our website. So you can see all the different resources at the top here that we have for investors. I'm not going to go into all of them today. But there's stuff for active investors, passive investors, depending on where you're at. And then there's a button right here to get qualified for our next investment. So that's a little bit about us, and you can, like, that website has so much stuff on it. This is pretty much we covered all of this, so I'm not going to go into this. And that is the end of my slideshow. So I'll stop my screen share, and I will put in the chat the website that I just mentioned, so you have that. I will also put in there our portal for accredited investors and non-accredited investors. I can't actually talk about what we have available on this because this is just an educational webinar, but if you're curious, go check it out. So first, I'll put it in there and I'll let Brian close.
Yeah. And I encourage people to reach out to you and get more answers. I mean, I think there's risk in anything that we do, and they should talk to you about, your due diligence and why you like these deals, and obviously why you're focused on certain areas and the space you're in. Did you put that up in there, Kelly, your info?
So I just put the website, and I'm typing out the site for accredited investors to go look at all of our stuff.
Okay.
The other ones, will be the non-accredited crowdfunding. I'll now label it so that you know.
Yep. And for everybody on today, this is in the chat box, so you can grab those. You can also get this, should be posted to our website in a few days, and you'll be able to watch replays of it. Okay, yeah, I see it there, Kaylee.
And if they can't actually, like, it's not a hyperlink, you can definitely copy and paste the link, and save it for later.
Right. Well, they can always get a hold of you through, theapartmentqueen.com, and there's links and everything for them to get there.
Go to theapartmentqueen.com. There's like a little bot that pops up on the bottom. She will help you to book an appointment, like a phone call, if that's what you want to. So just be nice to her.
Well, thanks so much for taking the time out of your day. I know you're very busy. Thanks for being with us today, and thanks for everyone who attended. If you have any other further questions about, retirement accounts and how to get those going, please reach out to me again, Ryan Fisher, rfisher@camaplan.com, and look forward to seeing you guys on our next upcoming events.
And that's one last thing I do want to close with. A lot of investors, I'd say over 50%, miss out on deals because they don't self-direct their accounts. It takes 4 to 8 weeks to actually get the money from this custodian in the mail to over here. It's nuts, and it's actually really stressful. So having your account already self-directed and open and ready to go, so that when an investment comes forward that you're interested in, and like I said, even if you don't have 50K in your account, you can still take it out and self-direct it and invest in some of these crowdfunding offerings. So get that thing open and self-directed today. It will just keep the pressure off of you as an investor. For example, we're on a tight time frame once we're under contract, so we have to pressure investors to get them going. If you already have it set up, then there's no pressure. It's just your choice if you're investing or not.
Yeah, no, absolutely. And I encourage everybody to do that as well, because I see it happen, and an opportunity comes up and somebody says, well, I have like 3 days to do this and close on this. And it's like, well, it's not going to happen in 3 days, because it's just the nature of it. Generally speaking, just for everyone out there that's listening, usually you can get something done within about 2 weeks. Obviously, you can set an account up, a Camaplan in about 15 minutes. You can do it right online, but I can't control how fast the brokerage house sends the money over to us. A lot of the times it's invested, so you'll have to, sell your, stocks or mutual funds or whatever it is. That'll take a few days. Then they got to process it and send it to us. Then we receive it. And by the way, our turnaround time is within 48 hours. So if you had your account open and funded, and you filled out your subscription agreement, for example, and put it with our form we call an asset purchase directive, that'll go out within 48 hours.
Wow. So yeah, y'all, but it always depends on where it's coming from. So we cannot predict that.
Right. So once we have it, then we have it in our control. But generally speaking, I tell everybody plan on at least 2 weeks, give or take, depending on who has it. But yep. And if you do have any other questions, feel free to reach out to me. Thanks so much, Kaylee.
Thank you so much, Ryan.
All righty. Bye.